The strategy is called the wheel, and I explained it in detail in another video. So we'll post the link to the other video in the description. But let me give you a very brief review. It's an option trading strategy, as you can imagine. And you already know, when you buy a call, you have the right to buy 100 shares of a stock at the strike price. When you sell a call, you have the obligation to sell 100 shares at the strike price. When you buy a put, you have the right to sell 100 shares of a stock at the strike price. And when you sell a put, you have an obligation to buy 100 shares. So this is a super brief recap. And if this is new to you and you say, oh my gosh, I don't know what you're talking about, I also have a course. It's called Options 101. It's a free course. I'll link to it in the description. So if you're absolutely new to options, I recommend that you watch that course first, the Options 101. Pause this video, watch that, and then come back here. In a nutshell, here is what this strategy is all about. It's a strategy that actually Warren Buffett likes to use, because the idea here is you're selling puts and therefore you get paid while you wait to buy a stock. And I want to give you some very specific examples here and show you how I'm planning to trade this. So the important thing here is you must be okay owning the stock. So which stock would you be okay owning? So one of the examples that I want to show you here right now is Budweiser. Not a big fan of their beer, but as a company, as you can see, yes, they were hit by the pandemic because, restaurants closing, right? Bars closing, nobody's buying kegs of beer anymore, but this doesn't mean that Americans will stop drinking beer. And it seems that Budweiser and the other beers that they make, as you know, there are several brands, are just popular beer. They do the Super Bowl ad every year, right? So this is where you might say, you know what? Yes, I think that they had a low here at 33, but in the long run, they'll go up. So maybe you'll even say, yeah, they will go up probably to $80, $90. Who knows? So this is where you would say, okay, you are interested in owning the stock. So this means that now we are selling a put, because when you sell a put, you receive a premium and you have the obligation to buy 100 shares of a stock at the strike price. Let's actually go over to a calculator, because I love to use tools. In yesterday's Coffee with Markus, I showed you why tools are important, and I've given you a glimpse at this tool here. But I want to show you a little bit more of what this can do in this particular example for Bud. So this tool is called the Wheel Income Calculator. So the buying power that I have set aside for trading this strategy is $100,000. So that's a medium-sized account. You can trade it with a much smaller account. And we'll talk about this a little bit later of how big your account should be. But for me personally, it will be a $100,000 account. The maximum number of positions that I'm willing to take in this account is 5. So let's take a look at Bud. First of all, we need to fill in the stock price of Bud. And right now, Budweiser is trading at $54. You see it here, $54.44. And now the key question is, at what price would you be willing to buy this stock? Look at this. Would you be willing to buy the stock if it goes down to 52 or 50 or 48 or 46, right? For me, right now, it is at 54. If it comes down to 50 right here, I would be okay buying the stock, because as you see, it dipped slightly below 50, but then it quickly bounces up to 55. Again, the important thing here is you must be okay owning this stock at the strike price. If you're not, pick another stock. And we'll talk more about picking the right stocks here in just a moment. So bear with me. I just want to show you the example. If we go back and we say here the option strike price is 50. This is the price at which you would be okay buying it. So you would sell a put at a strike price of 50. And this is where we need to see, okay, how much could we actually get right now if we sold a put with a strike price of 50. That expires in a little bit over a week from now. So we would get bid and ask is 37 over 43, so probably 40 cents. Now, very important, if I have $100,000 buying power and I would like to trade a maximum of 5 positions, this means that I can allocate $20,000 to each of the positions. So for Bud, I would reserve $20,000 in buying power. So this means that I will trade 4 options. And you see, all of these white fields are automatically calculated for you. So this is why I love tools, because they make my life so much easier. So I would collect a premium of $160. And I might say, ugh, $160, that's not a whole lot. Well, it's $20 a day because in 8 days it is expiring. And these $20 a day include the weekend. So while the markets are closed, you're collecting $20. And think about it this way. This is just one of the positions. If I can collect $20 per day for each of the positions that I will put in my account, as I will have more in there, would be $100 a day. That's $3,000 a month. Not too shabby, right? So this is where we look at, okay, annualized, the premium would be 36%. And a 36% return is not bad at all, right? So this is what we would do. We would just sell it and then wait until expiration, which is in 8 days from now. And at expiration, there are two possibilities. So either at expiration, but moved below 50, and if it moved below 50, we now own the stock. We now own, see, since we sold 4 options, we would own 400 shares of BUT. And I would be okay with this, owning 400 shares of BUT, because I'll show you in a moment what exactly I would do then when I own 400 shares of BUT. But scenario 2, BUT stays above 50, so we just keep the premium that we received for selling this put, and we can do it again. And again, collect $20 a day for making sure that BUT keeps going higher, or just sideways, or even slightly down. That's the power of the strategy, because it doesn't really matter. I mean, as long as it stays above 50, we're good. Even if it dips slightly below 50, if it closes at expiration above 50, we're just fine. So this is where we can do it again and again. But let's talk about it if we're getting assigned. So if suddenly we would own 400 shares of Budweiser, and since it is difficult to predict the future, and this is where the second part of the strategy kicks in, this is where it is the wheel, let's just say that we bought it exactly at the price of today. Let's just say that we bought it at 54.45. So again, we would trade here 400. So we would have 400 shares, okay? And now we can sell a call against it. That's called a covered call strategy. And we could see what would make sense. So for example, 57.50. And as you can see, if we are selling this, we would get probably around, 68, 70 cents, something like that. So we're going back to the calculator and we're getting, let's say, 68 cents. So this means now, as long as BUT stays below 57.50, I'm marking it right here, after we own it, we just keep the whole premium. If it moves above 57.50, that's good for us, right? Because we would own it at 54.45. And so we make even more money in addition to the option premium of $272, which is $34 a day right now. We would make an additional $1,220. I mean, this is why I'm really excited about the strategy, and I know that I'm going super fast here. I will answer your questions because there are more in-depth videos that I have. So they're right here. We posted in the description. It is about the strategy, the wheel, and then also a second video where I showed the tool. But when I recorded the other videos, I promised that I'll do a special session today for you where I answer your question, because there were so many questions around this strategy that first of all, I decided that I will do a full-blown course around this. And this will be here under rockwelltrading.com/blueprint. But let's make sure that I'm also answering all your questions. And there he is. There is the most interesting man in the world talking about BUT and Dos Equis. I believe Dos Equis is part of Budweiser. It's one of the brands. So it says, my limit order to buy call options got filled below my limit price. That makes sense. That is not weird at all. When you are buying options, you specify a limit price, and a limit order means or better. So if you say, I want to buy them at $1.30 or better, it means that you would buy them at $1.20, $1.10, $1.90. This making sense? Jim says, I've bought from last year and I started in a negative position, down about 4,000 right now. You see, this, Jim, where this would probably be perfect for you, because what you can do right now is that you sell calls against it, and this way you receive premium. Now, for you, let's go back to the screen here. One of the challenges, Jim, for you is that you probably bought BUD at a higher price, let's say $80. So if you're getting called away here, you want to immediately kind of buy it back so that you can make back the money that you lost. I believe that this would be a perfect strategy for you, especially when you own a stock and you're upside down in this one. So Jean is asking, can we use this strategy in the same margin account that we use for PowerX Optimizer if we already have positions? Yes, and you need to make sure that you reserve enough buying power if you're getting assigned. So the calculator shows you exactly how much buying power is needed to buy the stock. So you want to make sure that even though you have other positions in there, you still reserve some buying power for this. So you can trade it on a smaller account. So for example, if you would trade it on a $20,000 account, right, then here for this particular position, Jean, you would reserve $5,000 in buying power, and you make sure that this is untouched, okay, just in case you're getting assigned. So you want to make sure. But yeah, absolutely, you can do this. So Jim says, I have 88 shares. This is the challenge. In order to trade this strategy successfully, you need to have at least 100 shares. So Jim, might be a little bit difficult for you to trade this particular strategy on the stocks that you already own, but you can trade it on other stocks, right? So Vote says, before going into a stock, study the chart. Well, again, in general, Vote, this is a great advice, and I always highly recommend having a stop loss. For this particular strategy, it is just picking a strike price at which you want to be assigned. No FOMO. One says, can you please touch on the Greeks in order to put this strategy to obtain the probability of success? Also, do you need to hold the position until expiration? So first of all, let's talk about the Greeks. It's theta, it's gamma, it's delta. I personally do not use the Greeks for this strategy, because what I do is that I just look, first of all, at the chart to see at what price would I be willing to buy that stock, right? I mean, this is the governing principle. And then I use my calculator so that I see, does it make sense for this particular stock at this strike price? Because you see, if I would only get, let's say, 25 cents, this starts flashing in red. Because now it says, okay, I would only make 23% per year annualized, and for me, that's not worth doing the strategy. So I need to make sure that I achieve a certain amount. And also, if, for example, I could get 70 cents, this means that I could make 63% annualized. So it flashes yellow right now because this is a warning sign that probably you're too aggressive on your strike price, or you're possibly trading right into earnings where you have inflated premium. So the coloring here makes it super easy so that you know exactly when you are in the strike zone, right? So when it is green, and if it is red, it's not worth doing it. And if it is yellow, it's warning. The RI is a little bit too high. It could be that you're too aggressive here. Karina is asking a great question. To sell puts, shouldn't we have bought the puts first? Did I miss something here? And why 4 trades? Well, let's go back here. First of all, you can do any of these 4 things that you want first. You can either first buy a call and then sell it later, or you can first sell a call and then buy it later. You can first buy a put and then sell it later, or you can sell a put and then buy it back later. It doesn't really matter in what order you do it. So you don't have to do this. So now the question is, why 4 options? And I'll show you. This is why you want to see that you have your buying power up here. See, for example, if you only have $20,000 in buying power reserved for this strategy, then you would only trade 1 option. So it really depends. And also, if you want to trade a maximum of 3 positions, well, you can still only trade 1 option here, because this is where you need to set aside $5,000 in buying power. So you can first sell puts and then later you have to buy them back, or you let them expire worthless. And this is the main idea here. Ali Reza says, finding the strike is so important. I absolutely agree. And this is why here, you see, this is why I'm having the spreadsheet. Because, for example, if I go to the chart of BUD, if we go back to our example here, and we say, okay, let's say I want to go to a 48 strike. So I want to give it a little bit more room. You will see that there's usually not enough premium in there. So if you go to the 48, and now we see how much premium we would get at the 48, see we only get around 20 cents, 25 cents. So let's just say that, let's be generous, and let's say we're getting 25 cents. See, this is when it is flashing red because it means that you're not getting enough premium to make it worth your while. You can say, okay, do I want to go maybe to 49, where you can get 30 cents? So we can try this, right? You plug in 49 and you see you would get 30 cents. It's going up to 28%, and you could say, well, 28% is good enough for me. For me personally, I would like to see at least 30% annualized. Otherwise, for me, no, it's not worth trading this strategy. The premiums stay the same until expiration. Ricardo is asking, well, the premium is what you receive when you're selling it and you have it in your account. And of course, the premium changes every day, but not in your account because you have received it. It's like if you're selling something, we're selling a put, right? Let's say you're selling your bicycle and you get $300 for it. I mean, you have it, right? And the only way how you can give it back is if you want to buy another bicycle. Maybe for a cheaper price, maybe for a lower price. But yeah, VJ says, how to select the strike price? Again, you look at the charts and then you use the options income calculator to confirm that you're getting enough premium. So yes, this is where I feel having this tool, the income calculator, will help you tremendously. This is why I built it for myself, because I'm all about a systematic way to make money. Not guessing. We can start with guessing what would be a good strike price, but then we confirm to make sure that we really got it here, that we really nail it, and that we are not just picking it based on a gut feeling. We're picking it based on data here. Okay, Monica is asking, if you buy the stock, it would be at our strike price. Yes, but you have 54 as having bought it. How do you get to this price? Because in order to show you an example right now, Monica, it's hard to say, if next Friday we get the stock at 50, how much would the premium be, right? So this is where today, just for this example, I say, let's just say today is the day where you're getting assigned, and you're getting assigned at this price. It's for this example because, again, looking in the future and predicting option prices is really, really tough. So that's why I used it here. Doesn't the broker reserve the buying power automatically once you place the trade? It depends on the broker. I'm using Tastyworks, and now Tastyworks does not. Tastyworks, it is requiring a margin, but it is super, super low. Let me actually show you. For the butt trade, we have $100,000. So we would trade, okay, 7 options. So we're selling a strike price of 50 right here. And we're using 7 options. You see, the buying power that I calculated, which is the correct one, is 20,000, but the broker is only requesting 4,500. So Caleb, the broker does not do it, so you have to keep it straight. This is where the calculator really helps you tremendously. But great question. So Don is asking, is this a good idea for someone new to options, or should I wait? Actually, this is one of the easiest strategies when trading options. In fact, the second part of the strategy, selling covered calls, is what most people do to get started with options because it's so easy to understand. So Don, I believe it will be perfect. See, more complicated strategies are debit spreads, credit spreads, iron condors, butterflies, all this kind of stuff. We're not doing this. So Alireza says, for this strategy, I'm scared that the market drops very bad again due to the pandemic. Well, it might or might not, right? So remember, before we had the pandemic, the market was in a bull market for 11 years, the longest bull market in history. So think about it this way. Yes, absolutely, it is very bad if the market drops again, right? Then you just have to keep selling calls and you will be trapped in these stocks for a while. But as you can see, let's just go back to the charts. I mean, first of all, will it drop again due to the pandemic? I don't think so, because we already know what happened here. So even if you have a second wave or a third wave, I don't think it'll get worse than it did before. But hey, that's an opinion. And you see, if we look, for example, at the SPX, you see how quickly we bounced back from this drop here. And if you look at the Dow, it's a little bit less here, as you can see. And if you look at the NASDAQ, you see that here we even made new all-time highs because some stocks did really, really well due to the pandemic. So if you're too concerned about that, there's hedging strategies that you can do. You can buy options on the SPY, put options if you're too concerned about it. So there's several things that you can do. So Marina is asking, can you do fewer positions, say 3? Absolutely. So this is where we go back to the income. So let's say that you do have only a $10,000 account and it's a margin account, so you have $20,000 in buying power. And here you want to put on a maximum of 3 positions. So in this case, you only would trade 1 option or maybe even 2 options, right? So yeah, Marina, absolutely you can trade fewer positions here. Brian is asking, do I keep the premium even if you get assigned? Yes, you are. Yes. You keep the premium. The premium you keep regardless, whether you're assigned or whether they expire worthless. You always keep the premium. So great question here. Juan says, how do you scan for the highest premiums? Well, again, you're first of all picking the stocks that you want to own, and then you plug them into the income wheel. Around what is the expected weekly income possible on 100,000 buying power? So this is a powerful strategy where you can expect to make around 30% per year rather safely. Based on my experience, it's probably closer to 40 or 50%. But let's just say that you have a $50,000 account, okay, and this is a margin account, so you're getting $100,000 in buying power. On this $100,000, you would expect to make at least 30%, because you have seen, if I can make at least 30% per year, I'm not even trading this stock. I'm not trading the strategy. So you're looking at $30,000 per year. Now, since you're trading it in a margin account here, again, based on the $50,000, right, you're looking at 60%. So let's say, and $30,000 per year, and you divide this by 52 weeks, because you asked how much can you make weekly. It's around $580 per week. So what does it mean? It means that a little bit over $2,000 a month. I think not bad, because all you need here in terms of time is actually a few minutes per week. So it's not as active as PowerX Optimizer. This is why on PowerX Optimizer, we expect to make at least 60%, right? A few other questions, because they came up earlier here. First of all, let's talk about account size. What is the minimum account size that you should have? Well, if you're having a margin account, you should have at least $10,000 so that you have $20,000 buying power. If you have a retirement account, I would recommend at least $20,000 in your retirement account or in your cash account. The other question is, what broker should you use? You can use any broker that you want. I personally will use Tastyworks for this. And if you would like to have more information, just go to rockwelltrading.com/tastyworks. This is where you get more information on Tastyworks. You can open an account if you want to. How much time does it take? How long? So it's usually just once per week. And sometimes we only trade a monthly option. So it would only one time per month, once a month. And again, you would receive the newsletter, or if you do it yourself, you would actually scan for it over the weekend and then trade Monday morning. Don't have to be there when the market opens. You can even place the trades on Sunday. That's not a problem at all. So you can do it on the weekend. That makes it really, really, really cool. The goal, we talked about it, at least 30% per year. So this means on a margin account, if you're trading a margin account, you would make at least 60% per year. That is the goal for the strategy. That's how I program the tool. I would not take any trades where I wouldn't make at least 30% per year. Anyhow, does this replace PowerX Optimizer? Absolutely not. This is a great addition to PowerX Optimizer. So if you're using the tool PowerX Optimizer, this is a great addition. If you're using the PowerX strategy, it's a great addition. So absolutely, it is not replacing it at all. So Jeff says, I love this strategy. I've been using it on a few stocks now. The longer out your expiration, the more premium you make. Yes, but here's the important thing, Jeff. So this is what, I'm glad that you're bringing it up. The most important thing, because let me show you an example here. So the most important thing here is that you look at how much are you making per day. So we're going back to our BUT example here. So the BUT example, a 50 strike, let's go back here. for the 50 strike, we would probably get 40 cents. Again, right now the markets are closed, so the bid-ask spread is a little bit higher. So we would get 40 cents with an expiration of July 31st. So this means that we are collecting $40 total, and the premium per day is $35. Okay, write this down. Keep this in mind, $35. Now let's say if we are going out, we're going out further, as you suggested, to August 20th. And we look at the 50 strike price, you're absolutely right. We are getting probably around $1 here, right, if we would sell this. But we're getting $1, and we have now 29 days to expiration. So this is why I wanted to have a tool that helps me. So if you're getting $1, or let's even say we're getting $1.05, but now we are choosing September 24th, look at this. The premium per day is only $26. So Jeff, you're absolutely right. The longer the expiration, the more premium you make, because here I'm getting $1.05 versus 40 cents, but I'm also getting $1.05 for 28 days, right? So super important that you understand this principle. You always want to check how much am I making per day, because as you can see, trading the shorter expiration here makes so much more sense, doesn't it? But what if the stock goes down? Monica, great point. If the stock goes down, we keep selling calls. I mean, this is why we want to trade stocks that we believe will go up in the long run, like Budweiser, like Boeing, for example, like, I don't know, Caterpillar. I mean, the stocks, the good old, this is where we talk, somebody said it earlier, like dividend stocks, right? And stocks that the big guys have in their portfolio, stocks that Warren Buffett is interested in, Coca-Cola, Apple, these kind of stocks. Because yes, while they're going down, we need to keep selling calls, right? And the idea here is that we pick stocks that are going up in the long run. And here's the deal. Since we're trading this with weekly options mainly, if we see that a stock keeps going down, if it plunges below its 200-day moving average, we stop trading this stock, Monica, and we can move to another stock. So Brick is asking, what is the downside to buying shares of a stock, expecting it to go up, at the same time selling an option call at a highest price? Hope that it doesn't go that high. That is the second part of the strategy. Right? So the idea here is if you already have stocks, you would absolutely do this. It's called covered call. Very easy. We're just adding a second layer. And the second layer is either if you're getting called away, right? So if it moves above the strike price of the call that you sold, or if you're getting assigned, right? So this is where, that's why it is a wheel. You just make more money this way than just having the stock. If you enjoyed this, please make sure that you share this video, and I'll see you in the next one. Take care.